So big institutions and crypto. Huh. It's like they're kind of circling each other. They're trying to figure out how to make this whole thing work.
Yeah, it's a bit of a dance. Lots of potential, but tons of risk too, right?
Exactly. And that's where Basel III comes in, this global framework. It's not just about banks, though. It's kind of reshaping the entire financial landscape.
It's wild how Basel III is like setting the stage for how institutions like interact with this whole new world of digital assets.
Totally. It's like building this bridge between like traditional finance and the whole decentralized frontier.
Yeah, exactly. And today we're diving deep into how that bridge is actually getting built.
Love it. We're digging into a recent blog post called What Basel III's 1,250% Crypto Risk Weight Means for Institutional Adoption. Catchy title, right?
Oh, for sure. It gets right to the point, That post hits on this key idea, classification.
Oh, interesting. Like sorting things out.
Exactly. Basel III basically sorts crypto assets into two main groups. Each one has its own set of rules and, well, it impacts how institutions can deal with them.
So like financial sorting hats. I love it. Okay, let's start with group one then. The lower risk assets, according to Basel III. What kind of stuff falls under that?
So Group 1 is actually split further into 1A and 1B. Group 1A is all about tokenized traditional assets.
Tokenized traditional assets.
Yeah.
Okay, so like imagine a stock or a bond, but on a blockchain.
Exactly. Same asset, just with a digital upgrade. And then you've got Group 1B where you find all those regulated stablecoins.
Ah, the stablecoins. So like Tether and USDC and all those.
Well, yeah, but specifically the ones that are really buttoned up, strong mechanisms to keep their value stable, clear backing with top-notch assets.
So group one is kind of like dipping your toes into the crypto pool, but with a lifeguard on duty.
That's a great way to put it.
But why is this distinction, like group one versus the rest, so important for institutions getting involved?
It all boils down to capital requirements. You see, institutions holding Group 1 assets, they face way lower capital requirements compared to holding, well, the riskier stuff.
Ah, okay. So lower risk, lower capital requirements.
Yeah.
Makes sense.
Right. And that's a huge incentive for banks or like asset managers looking to explore crypto without, taking on insane amounts of risk.
Gotcha. Now, let's head into the Wild West of crypto, shall we? What makes Group 2 assets different? And why are they seen as, riskier by Basel III?
Group 2 is where things get really spicy. It's like the catch-all for assets that don't fit neatly into that nice regulated Group 1 box.
Okay, so we're talking like unregulated stablecoins.
Yep, those are in there. But also Bitcoin, Ethereum, basically anything that doesn't have that familiar regulated face.
Wait, so even the big names, Bitcoin and Ethereum, they end up in this riskier category.
That's right. And even within Group 2, there's another split, 2A and 2B.
More sorting hats. Okay, I'm intrigued. What's the deal with Group 2A then?
Group 2A is fascinating. These assets can actually act as a kind of like shock absorber. They can hedge against risk.
Oh, interesting. Okay, give me an example.
Sure. Think of a centrally cleared derivative that's tied to crypto. Or even an ETF that spreads its holdings across, a basket of different assets. These can help offset the crazy volatility of something like, say, Bitcoin.
So even in the Wild West, there are ways to play it safe, at least in the eyes of the regulators. But there's this one thing about Basel III that everyone's kind of freaking out about, right?
You mean?
The 1,250% risk weight.
Yeah.
Especially for Bitcoin. It sounds scary, right?
Yeah, it definitely grabs your attention. But let's break it down, make it less, intimidating. A risk weight is basically how regulators signal how risky they think an asset is. The higher the number, the more capital a bank needs to hold, just in case things go wrong.
Ah, so it's like a safety net. More risk means a bigger net.
Exactly. And that 1,250% for Bitcoin, yeah, banks have to hold a lot of capital to cover their exposure.
So in plain English, a high-risk weight means banks got to set aside a ton of money just in case that asset tanks.
You got it. It's all about that financial cushion.
Okay, let's get specific. If a bank wants to hold, say, $10 million worth of Bitcoin, how does that 1,250% actually play out? Like, what happens?
That's where the math gets kind of wild. Because of that risk weight, that $10 million in Bitcoin is treated as if it's worth, wait for it,
$125 million.
You got it, at least from a regulatory standpoint. And on top of that, Basel III requires banks to hold capital equal to at least 8% of their risk-weighted assets.
Hold on, let me do the math here.
Yeah.
So in our example, the bank needs $10 million in capital just to cover that $10 million Bitcoin investment. That's intense.
It's a serious chunk of change, and that's exactly what that blog post is highlighting.
Yeah, I can see why banks might be hesitant.
It's a huge financial hurdle for a lot of institutions, especially the ones that aren't super comfortable with risk.
This makes me think there must be other, like, smarter ways for institutions to get into crypto without getting crushed by these capital requirements.
Right.
There's got to be.
You're spot on. That blog post actually digs into that, especially the whole crypto ETF thing. They could be the key to bridging this gap, between traditional finance and crypto, but in a way that keeps Basel III happy.
Okay, love it. Let's break it down. For those who might be new to this, can you explain, like, what exactly is a crypto ETF and how does it work?
Imagine a basket of assets, like stocks, bonds, the usual, but instead it's filled with, well, crypto stuff, like Bitcoin, Ethereum. An ETF, exchange traded fund, is like a slice of this basket, and it trades on a stock exchange, just like any other stock.
Gotcha. So instead of buying Bitcoin directly, you're buying a piece of this ETF that holds Bitcoin.
Exactly. It lets investors get into crypto without actually, well, holding the assets themselves.
So how do ETFs deal with Basel III? Do they get hit with that same 1,250% risk weight as, like, holding Bitcoin directly?
That's where things get clever. ETFs, especially those with a good mix of different assets, can actually qualify for that Group 2A hedging category we talked about. Remember, the shock absorbers.
Right. The ones that make Basel III a little less stressed out.
Exactly.
So by investing in a crypto ETF, institutions might be able to lower their overall risk weight compared to just holding Bitcoin. That sounds like a pretty good deal.
It could be. And the blog post points out a few specific types of ETFs that are like super relevant here. First up, you've got those Bitcoin futures ETFs that are already approved in the US.
Right. The ones that track the price of Bitcoin futures instead of actually holding Bitcoin.
Yep. Then you've got physical Bitcoin ETFs in Canada and some other countries. Those DO hold the actual Bitcoin.
Okay, so two flavors of Bitcoin ETFs already. What else?
And then there's this whole world of like tokenized ETFs. They live on the blockchain and they offer a ton of potential for, well, making things more efficient and transparent.
Sounds like there's a whole ETF buffet for institutions to choose from. But out of all these different types, which ones do you think have the best shot at winning over those institutional investors? The ones who are keeping a close eye on Basel III.
Good question. I think the answer might be diversification.
Not putting all your eggs in one basket.
Precisely. ETFs that spread their holdings across a bunch of different crypto assets, maybe even throw in some of those tokenized traditional assets, those could potentially get a much more favorable risk weight under Basel III.
So diversify within crypto, A&D, blend in some of those more familiar regulated assets.
Exactly. It's all about finding that sweet spot where institutions can tap into the potential of crypto while still keeping their overall risk level, well, within what Basel III considers acceptable.
This is giving me a much clearer picture of how institutions can navigate these tricky waters.
Yeah, it's a bit of a maze.
But let's not forget about stablecoins. They're a huge EG part of the crypto world. Do they get lumped in with Bitcoin, facing that intimidating 1,250% risk weight?
Nope. That's where the difference between Group 1 and Group 2 stablecoins really matters. Trust me, this gets super interesting when we're talking about like who's actually going to adopt crypto.
Okay, I'm all ears. What's the difference between those two stablecoin groups? And why should institutions care?
Remember those Group 1 stablecoins we talked about earlier? The ones that meet all of Basel III's strict criteria? Those are the golden child, so to speak. They enjoy much lower capital requirements, which makes them way more appealing to institutions.
So banks could use Group 1 stablecoins for stuff like cross-border payments without having to set aside a mountain of capital. That's huge.
Exactly. It's a way to tap into the cool stuff about blockchain, the speed, the transparency, the lower costs, without tripping over all those strict capital rules. It's a win-win.
So what about those Group 2 stablecoins, the ones that aren't quite as well-behaved? What does the future hold for them, especially with institutions getting involved?
Well, sadly, they're facing an uphill battle, kind of like Bitcoin. Those high capital costs for Group 2 assets are likely to keep them, well, out of the institutional game, at least for the foreseeable future.
So it sounds like Basel III is kind of like reshaping the stablecoin landscape. It's creating this divide between the good and the, well, not so good.
That's a really sharp observation. And it leads to some big questions, like will all this regulatory pressure lead to a stablecoin shakeup? Will we see institutions flocking to those Group 1 stablecoins, leaving Group 2 in the dust?
It's definitely something to watch, but it's also important to zoom out, right? See the bigger picture. Stablecoins are one thing, but Basel III's impact goes way beyond that.
Right.
It's about like reshaping the entire crypto ecosystem.
You got it. And that blog post really nails that point.
Yeah.
By setting these high standards, especially that crazy 1,250% risk weight for Bitcoin, Basel III is basically forcing the crypto market to grow up.
It's like, time to get serious, folks.
Right. It's weeding out the riskiest players and paving the way for a more mature, more institutional-friendly environment.
It's kind of like the early days of the internet, right? Lots of potential, but also a lot of, well, chaos. Then came regulations, standards, and the internet we know today was born. Could we be seeing the same thing happen with crypto?
That's a great analogy. Regulation, when it's done right, doesn't kill innovation. It actually helps it thrive. It builds a foundation for sustainable growth, makes things more legitimate, which attracts both investors and users. And that's what Basel III is doing for crypto.
It's like building that bridge we were talking about.
Yeah.
Connecting the traditional financial world to this new decentralized world.
Exactly. And it's being built from both sides, which is interesting. Regulators set the rules, create a level playing field that institutions understand, and then you have crypto projects adapting, becoming more transparent, more accountable.
So even though that 1,250% risk weight seems like a roadblock, it's also a push, right? It's pushing the crypto market to become more mature, more integrated. It's fascinating to see how it's all playing out.
Absolutely. It's like this dance between regulation and innovation.
Yeah.
And as it continues, there's this really crucial question we need to address.
What's that?
What does all this mean for the average person? You know, someone who's maybe curious about crypto, but kind of intimidated by the whole thing, all the complexity, the risk.
Yeah, it's easy to get lost in all the jargon when we're talking about, institutional adoption and regulations and all that.
Yeah.
But at the end of the day, we got to remember how it all affects, like, the everyday person, someone who might interested in crypto, but also kind of hesitant to jump in.
That's such a crucial point. See, Basel III isn't just about protecting banks. It's about safeguarding the whole financial system, which, in the end, benefits everyone, right?
So it's like a ripple effect. If a big institution makes a bad bet on crypto and, like, loses a ton of money, everyone feels it.
That's the idea. Think of it like this. If one big player stumbles, the whole system can get shaky. We've seen it happen before. It's not pretty.
Right. So by setting these like really high standards for how institutions can mess with crypto, especially with that massive 1,250% risk weight, Basel III is basically creating a safer space for everyone, even people who aren't like directly buying Bitcoin or whatever.
Exactly. It's all about minimizing that systemic risk, preventing those domino effects that can really mess things up. And as we've been talking about, this whole push for regulation could actually lead to way more mainstream adoption. Because, as crypto becomes more integrated with the traditional financial world, it also becomes more user-friendly, easier to access.
So instead of thinking of crypto as this like separate kind of shady world, maybe we're moving towards a future where it's just like baked into our everyday financial lives.
That's the vision. We're already seeing companies like, Visa and MasterCard exploring ways to integrate crypto into their payment networks. And with stablecoins becoming more popular, that volatility that scared so many people away is becoming less of a problem. This could be like the gateway to mainstream adoption.
That's super interesting. I'm curious, though, do you think all this regulation, especially the strict rules about like capital adequacy, could actually stifle innovation in crypto? Or will it, force it to grow in a more responsible way?
That's the big question, isn't it? It's a tough balance to strike. I mean, on one hand, those high capital requirements, especially that 1,250% risk weight, yeah, they could definitely scare off some players and make certain things, well, just too expensive to even consider.
Right, it raises the stake.
Big time. But it also forces projects to be smarter about risk, to build systems that are, well, robust enough to handle the scrutiny. It's like raising the bar for everyone.
So not necessarily killing innovation, but maybe like steering it toward a more mature, sustainable path.
Yeah, I think that's a good way to put it. And the blog post makes this point too. By setting these standards, Basel III is leveling the playing field, pushing the crypto market to, grow up, move past that Wild West phase and become a more legitimate part of the global financial system.
It's exciting to think about the possibilities, but we also got to be real, right? This isn't going to happen overnight. There will be bumps along the way.
Oh, for sure. There will be challenges, debates. It'll be messy. And that's why it's so important for everyone, even people who aren't like super into crypto, to stay informed, to understand how all of this could change the future of finance. Because it's not just about crypto, it's about all of us.
This has been an amazing deep dive. I really hope our listeners are leaving with a better understanding of how Basel III, especially that eye-popping 1,250% risk weight, is shaping the crypto world, not just for the big institutions, but for everyone.
I agree. It's complicated stuff, but understanding how regulation and innovation work together, well, it's crucial as we navigate this crazy world of finance.
Thanks so much for joining us for this deep dive. I think our listeners will be thinking about all this for a long time to come.
It was my pleasure. And remember, folks, knowledge is power. The more we understand these systems, the better we can shape a financial future that, works for everyone.
That's it for our deep dive on Basel III and crypto. Until next time, stay curious and keep exploring.